Welcome back to the deep dive.
Thanks for having me.
It is Monday, February 23, 2026. And today we're doing something a little bit different.
Yeah, bit of a reality check.
Exactly, because we are taking a narrative that has been just beaten into our heads for, what, 5 solid years now?
At least 5 years.
Right. This whole idea that the office is dead, that downtowns are these permanent ghost towns, and we are going to stress test that against some actual hard data.
It's the zombie narrative that just keeps shuffling along, isn't it?
It really is. Everyone just accepts it as fact now. But we have the 2025 annual report for Dream Office REIT right in front of us. It just dropped a few days ago.
Brand new data.
And looking at this, I mean, I have to ask you, are we actually seeing a turnaround, or is this just a dead cat bounce?
Well, that is the multi-million-dollar question right there. You see, Dream Office REIT is basically a proxy for the health of downtown Toronto.
Because they own so much of it.
Exactly. If the office sector is truly permanently broken, their annual report should be a complete disaster zone. But when you peel back the layers here, specifically looking at the Toronto Financial District, the data is telling a very different story than what you see in the headlines.
Okay, so let's set the scene for the listener before we get too deep into the weeds with the numbers. Dream Office REIT is a massive landlord.
Massive.
And their CEO, Michael Cooper, he opens this 2025 report with a message about, quote, stabilization and recovery.
Right.
Now, obviously, CEOs are paid to be optimistic. That's their job. So is he just spinning a good yarn here to keep investors calm, or does the math actually back him up?
Surprisingly, the math is really robust this time around. The most critical metric you want to look at here is occupancy.
Okay.
If you isolate just their downtown Toronto portfolio, the committed occupancy has hit 87.4%.
87.4%. Okay, let's just pause there for a second, because in a vacuum, if I'm looking at that number, it sounds fine, but it doesn't sound amazing. Historically, don't you want to see an office building in the 90s?
Yeah, in a perfect stabilized market, sure, you want, say, 92 to 95%. But you have to look at the velocity of how they got there.
The momentum.
Exactly. Just at the start of 2025, that exact same number was 83.8%.
Oh, wow.
So that is a jump of over 360 basis points in a single year. And in commercial real estate, specifically in a really mature market like Toronto, moving the needle by almost 4% in 12 months, that's heavy lifting.
That's not just a rounding error.
No, that represents a lot of signed leases.
Okay, so the momentum is definitely shifting, but who is actually signing these leases? Because I remember for a while, the big hope was that, tech startups would just swoop in and fill the void left by the big traditional corporate.
Right, and that didn't really happen. What this report shows is actually a return of the heavy hitters.
The traditional players.
We're talking about major Canadian financial institutions. Yeah. The turning point, according to the data, was really the fall of 2025.
That makes sense.
That is when the broad-based return-to-office mandates finally stuck. The banks essentially came out and said, look, the experiment is over, get back to Bay Street.
And when the banks move, everyone else has to move.
Precisely. It drove this massive wave of leasing activity from all the service providers, the accounting firms, the law firms that basically orbit the major banks.
It's an ecosystem. If the whales come back to the ocean, the rest of the fish are going to follow them.
That's a great way to put it. But there is another statistic hidden in here that I think is actually way more predictive of the future than even the occupancy rate.
Oh, what's that?
It is the sublet space.
The dreaded shadow supply.
Yes, because for the last few years, the real problem for landlords wasn't just empty buildings. It was companies actively trying to dump their unused long-term leases onto the market at a steep discount.
Right, so Dream wasn't just competing with other empty buildings. They were competing with their own tenants, trying to sublet at 50 cents on the dollar.
Exactly.
Okay.
But according to this new report, the national sublet space has dropped to 11.4 million square feet.
11.4 million. I mean, to a layperson, that still sounds like a massive amount of empty desks.
It sounds huge, but context is everything here.
Huh?
That number puts us right back to 2017 levels.
Wait, really? 2017?
But that was peak market. That was years before the pandemic, before Zoom was even a verb for most of us.
Exactly. What it means is the glut is effectively vanishing. The whole phase of corporate space optimization, which is really just a polite HR way of saying shedding square footage, it appears to be winding down.
So if sublet availability is back to 2017 levels,
it means tenants who need space can no longer just hop on the secondary market and find cheap, pre-furnished options. The bargain bin is empty. They have to go direct to the landlord.
which brings pricing power back to the landlord.
It lays the groundwork for it, absolutely.
Okay, so if the market is tightening up, let's talk about Dream's specific strategy here, because they seem to be making a very specific, almost concentrated bet. They keep calling it a flight to quality. They do.
But when you look at their map in the report, they are now 84% concentrated in downtown Toronto alone.
It is a very aggressive concentration.
Is that actually smart? I mean, if you take Finance 101, the first thing they teach you is diversification is safety. By going all in on Toronto, aren't they exposing themselves to massive geographic risk? Like, if Toronto sneezes, Dream catches pneumonia.
It is totally a valid concern, and some investors might not like that profile. But in commercial real estate, depth often beats width.
How do you mean?
Well, they aren't trying to be a mediocre landlord spread across 10 different cities. They want to be the dominant go-to player in the 1 square mile that matters most to the Canadian economy.
Right.
So they have actively sold off assets in the suburbs and in other provinces over the last few years to double down on the Toronto financial district.
And is that concentrated risk actually being rewarded?
The leasing velocity suggests it really is. Just look at the volume. In 2025, they secured 827,000 square feet of leasing. Compare that to 2024 when they only did 634,000. That is a huge surge in volume year over year. And here's the real aha moment in the data if you dig into it. There is a spread they mention that is absolutely critical to understand their future.
I think I saw this. They talk about a gap between, what was it, in-place occupancy and committed occupancy.
Right. And they note that the gap is currently 800 basis points.
Okay, you need to unpack this for us, because 800 basis points sounds like dry financial jargon, but I have a feeling it represents a very real amount of money.
It represents a massive amount of money.
Mm-hmm.
So in-place occupancy measures tenants who are physically sitting in the building right now.
Mm-hmm.
The lights are on, and they are paying cash rent today.
Okay, simple enough.
Committed occupancy includes those people, plus the tenants who have legally signed a lease but haven't actually moved in yet.
So there's a lag time.
There's always a lag in commercial real estate. But an 8% lag is huge. It means there is a massive cohort of tenants who have legally committed to paying rent, but they are currently in the fixturing phase.
Fixturing meaning they are doing renovation.
Exactly. Because of this whole flight to quality trend, tenants aren't just moving their desks into boring beige boxes anymore.
Right, they have to entice people back.
They're doing extensive, expensive renovations to make the office what they call commute-worthy.
Mm-hmm.
And that takes time. 6 months, sometimes a year.
So for Dream, that 800 basis point spread...
It is essentially guaranteed future revenue.
Yep.
It is contractually locked in, but it hasn't even hit their income statement yet.
Let me get this straight. If I'm an investor and I'm looking at their Q4 2025 revenue numbers, I'm basically looking at the past.
Yes.
The future revenue is already signed and sealed. It is just waiting for the drywall to dry and the construction crews to finish up.
It is a pipeline of growth that will naturally unlock in late 2026 and 2027. It's almost like having a winning lottery ticket in your pocket, but you're just waiting for the office to open so you can cash it.
That's a great position to be in. Let's move from the macro strategy down to the micro, because the report highlights a couple of specific buildings that I think really illustrate this flight to quality concept in action.
Sure.
It's easy for management to just say, hey, we have quality buildings, but what does that actually mean for the bottom line? Let's look at 67 Richmond Street West.
Oh, this is a fascinating case study. It's a heritage building. It's not one of those soulless glass skyscrapers. Dream took it, stripped it down to the studs, new HVAC systems, new lighting, new elevators, a complete top-to-bottom modernization.
And the report notes they leased the remaining 32,000 square feet to a major technology tenant.
They did.
But the rental rate is what really caught my eye here. We keep hearing it is a soft market and that landlords are desperate to get anyone in the door.
That is the prevailing narrative, yes.
But the initial rents they got here are $35 per square foot, and that escalates to $47.75 over the term of the lease. That does not sound like a desperation price to me.
It's really not. Getting nearly $48 a foot in a heritage building proves a very specific point. Tenants aren't looking for cheap space. They are looking for effective space.
So the whole death of the office thing really only applies to boring, outdated offices.
Exactly, the commodity space. The gray cubicle farms with the drop ceilings from 1990, those are dead. Nobody wants to commute for that. But if you have a modernized, character-rich space, tenants will gladly pay a premium because they need that specific environment to attract and retain top talent.
Makes total sense. Then there's another building they highlight, 366 Bay Street. This one has a totally different angle to it, sustainability.
Right.
Dream tapped into the Canada Infrastructure Bank, the CIB.
This is a really smart use of leverage on their part. The CIB facility provides low-cost government financing, but it's specifically earmarked for retrofits that significantly reduce carbon emissions.
And Dream drew about $8.9 million from that facility to overhaul 366 Bay.
He did.
So what was the ROI on that green investment?
They secured a full building lease, one single tenant locked in for 15 years.
15 years. That is an absolute eternity in today's economy. Why would any single tenant commit for that long when the world is changing so fast?
Because large tenants, especially if we're talking about the government or major multinational corporates, they have their own strict carbon reduction targets to hit now.
Ah, right?
They can't just rent any random building anymore. They need a building that actively helps them meet their internal ESG goals. So Dream basically went to them and said, look, we will retrofit this entire building to be green if you sign a long lease. It is a completely symbiotic relationship.
So all this talk about sustainability, it isn't just PR fluff for the annual report. It is actually a hardcore tenant retention tool.
It is a defensive moat. It locks a tenant in for a decade or more.
Okay, so they're maximizing the winners in Toronto. But let's be real, every portfolio has losers. And they had some assets that, frankly, no amount of fresh paint or new elevators could fix. I want to talk about the Calgary pivot, specifically 606 4th Street.
This is where we get into some really creative destruction.
Yeah.
Calgary has had a severe office vacancy crisis for a decade now. Dream had this building, 126,000 square feet, and management describes it in the report as tired.
And tired is basically real estate speak for money pit, right?
Pretty much. In a market that already has 30% vacancy, a tired building gets absolutely zero interest. So instead of fighting a losing battle trying to find office tenants who don't exist, they entered a joint venture to completely convert it into residential apartments.
Yeah, we hear about office to residential conversions all the time in the news. People act like it's this magic bullet for the housing crisis, like just turn the empty offices into condos.
Oh, I know.
But usually when I talk to developers, they tell me it's near impossible. The plumbing doesn't line up, the floor plates are way too deep, so there's no natural light, it's just too expensive. Why is Dream able to do it here?
You are right. Usually the math just does not work.
Yeah.
The cost to gut and convert an office is often higher than just buying an empty lot and building from scratch. The only reason this specific project works is government intervention. Dream secured a direct grant from the city of Calgary, and crucially, they got 10-year government financing at very attractive rates to make the math pencil out.
So without those specific subsidies, this building would probably just sit empty.
Highly likely, yes. But with those incentives, they can turn a non-performing debt asset into a 166-unit residential building.
Which creates a totally new asset class for the REIT.
Exactly. And it diversifies them away from the volatile Calgary office market. It is a classic case of pruning the portfolio to remove the dead weight.
And speaking of pruning, they also cut the very last branch off their U.S. operation.
The Kansas sale, yes. 12800 Foster Street in Overland Park. They officially sold it in January 2026 for $7 million US.
So this marks the official end of their international ambitions.
For now, yes. They are now a 100% Canadian pure-play office REIT.
That makes the pitch a lot simpler.
It vastly simplifies the story for investors. If you buy in, you don't have to worry about currency fluctuations or obscure local tax laws in Kansas. You are buying the downtown Toronto recovery, period.
Okay, so we have a cleaner portfolio, we have rising occupancy, we have some really smart pivots, but we cannot ignore the elephant in the room here.
The financials.
The financials. Because when I look at the headline number for 2025, it is ugly. A net loss of $160.1 million.
It is a very scary headline number.
I mean, if I ran a small business and I lost $160 million, I'd be fired immediately. How do you explain this to a retail investor without it sounding like you're just spinning bad news?
You have to separate what we call accounting losses from actual cash losses. The vast majority of that $160 million comes from fair value adjustments. Specifically, there was a $147.3 million write-down on their properties.
Okay, but a write-down still means the assets are worth less than they were. That is real wealth evaporating, isn't it?
It is equity value evaporating on paper, yes. But it is entirely driven by the math of interest rates, not by the physical performance of the building itself. This is all about cap rate expansion.
Walk us through tap rates really quickly for those who might not be familiar.
Sure. The capitalization rate is basically the annual return an investor expects to get from a property. When overall interest rates in the economy go up, investors naturally demand a higher return.
Because they could just get a safe return from a government bond instead.
Exactly. And mathematically, demanding a higher return means they will pay less upfront for the exact same income stream. So even if Dreams buildings are generating the exact same rent, or even higher rent like we saw with the renewals, the value of the building on paper drops because the cap rate went up.
Oh, I get it. So it is like owning a bond where the trading price drops because the central bank raised rates, but your actual coupon payment that you get in the mail is still exactly the same.
That is the perfect analogy. The tenant is still in the building. They are still paying rent every single month. The cash flow is still there. But the accountant's valuation model says the building is worth less today than it was a year ago.
So it's a non-cash loss.
Right. It doesn't actually drain a single dollar from their bank account.
Okay, so let's look at the number that does affect the bank account. Funds from operations, or FFO, because this is basically the holy grail metric for REITs.
Correct. This is the actual cash generated by the business that is available to pay distributions to the unit holders.
So diluted FFO per unit came in at $2.46 for 2025. But in 2024, it was $2.98. So cash flow actually is down. That is not a paper loss. That is real.
That is very real. But again, we have to ask why it went down. It is not because tenants suddenly stopped paying rent or moved out en masse. It is because Dream actively sold off assets.
Right.
They sold a major property at 438 University Avenue, and they also sold a significant chunk of units they held in Dream Industrial REIT.
Basically selling the family silver to pay down the credit card bill.
In a way, yes, but it was a very calculated defensive move. They used the proceeds from those sales to aggressively pay down debt. So yes, they have less total income coming in because they own fewer assets, but they also have significantly less interest expense going out and a much safer balance sheet overall.
They chose long-term safety over maximum immediate income.
Exactly.
And just a quick heads up for anyone pulling up the stock chart at home right now, there was a consolidation, right?
Yes, very important to note.
Yeah.
Back in February 2024, they did a 1-for-2 unit consolidation.
Right.
So if you are comparing that $2.46 FFO per unit to numbers from, say, 4 or 5 years ago, you have to make sure you adjust for that split, or your trend lines are going to look very confusing.
Okay, so they have shrunk the portfolio, they paid down debt, they took their lumps with the write-downs. How safe is the distribution at this point? Do they actually have enough cash to keep the lights on if things get bumpy again?
The balance sheet actually looks quite robust now. They report total liquidity of $172.7 million.
Which is cash and credit?
Cash on hand, plus their completely undrawn credit lines.
That is a pretty decent buffer.
It is. And crucially, they have proactively addressed their debt maturities. If you remember, one of the biggest fears in 2024 and 2025 across the whole sector was this massive wall of debt coming due at much higher interest rates.
Yeah, the refinancing cliff.
Right. Well, Dream has successfully refinanced or paid off $741 million of debt in 2025 alone.
So they aren't facing some sudden liquidity crisis next month.
No. They have actually tackled a significant portion of their 2026 maturities already. They are well ahead of the curve.
And the people actually paying the rent, the tenants we established earlier, that they are high quality. But how high quality are we talking?
This is what I call the sleep well at night factor for investors. Their single largest tenant is the Government of Canada.
AAA rated. They aren't going bankrupt anytime soon.
Exactly. And they make up 6.2% of the REIT's total revenue. Then you also have the Government of Ontario. You have State Street. These are massive institutional-grade tenants. And the weighted average lease term remaining across the portfolio is 6.2 years.
So they have real visibility. It is not like running a hotel where you literally have to resell the room every single night.
Correct. They have a very long, predictable runway of secured cash flow.
So if we pull all these different threads together, it feels like Dream Office REIT has basically spent the last 3 years living in a construction zone, literally with all the building renovations we talked about, and metaphorically with restructuring their balance sheet.
That is a very fair assessment. They have been down in the basement fixing the foundation.
And now?
Now, management explicitly states in the report that the major renovations are substantially complete. They are signaling a major shift from this painful construction phase into what they call the harvest phase.
The harvest phase. I like the sound of that. But obviously, a harvest relies on the market actually cooperating with you.
It does. But here is the final, somewhat provocative thought that I think we really need to leave you with today. We have spent 5 years obsessing over this supposed glut of office space.
Right, the empty towers.
But because of that intense obsession, developers completely stopped building. New office construction in downtown Toronto right now is at historic lows. Only 1.9 million square feet is currently underway.
Wow.
In a global financial hub the size of Toronto, 1.9 million is basically a rounding error. It is negligible.
So there is absolutely no new supply coming to the rescue.
None. And as we discussed earlier, the cheap sublet supply is rapidly vanishing.
So if the broader economy holds up, and if these strict return-to-office mandates from the banks continue to bite, are we actually setting ourselves up for a supply shock?
That is the exact scenario that almost no one on Wall Street or Bay Street is pricing in right now. Everyone is mentally prepared for a continued miserable slump. But if tenant demand ticks up even slightly over the next 2 years, there is no release valve.
Because there are no new shiny towers opening in 2027 or 2028 to soak up that demand?
Exactly. Which means rents could spike.
Significantly.
And suddenly, the downtown landlord, who's been the ultimate underdog for half a decade, holds all the cards again.
From the death of the office straight to a shortage of premium space, that would be the ultimate contrarian bet.
If that dynamic plays out, Dream Office REIT is perfectly positioned to capture it. They have the premium, modernized space right now, just sitting there, ready to lease into a rising market.
It is a totally fascinating setup. I guess we're going to have to check back in a year to see if the gamble actually paid off. Thank you for joining me, and thanks to you for listening to the deep dive. We will catch you next time.